Hello, welcome to the South Arts Tax Q&A follow-up video for 2024. You all had so many incredible questions during the webinar. We wanted to make sure we took some time to follow up and answer all the questions we couldn't answer live. I am Elaine Grogan Luttrull. It is absolutely my pleasure to be here with you today. And with that, let's dive on in. So when you're thinking about the categories to use for Schedule C, it is okay to make your best guess as you're deciding which category makes the right sense for your expenses. The instructions to Schedule C are super helpful in giving examples of what might go into different categories. And if you're keeping track of your expenses over time, you can kind of make a good guess and use consistent categories year after year. Obviously, we don't want to put everything in one category like supplies. We want to make our best guess, but it's okay if you put something in its own category in Part 5, and really it might be better in office expenses, for example. Just be consistent from year to year. It would be nice if you always got the exact right paperwork that you needed, but that's not always going to be the case. So your job is to keep track of your income and expenses, just like you said, maybe by keeping track of your invoices or tracking all of that income in one of the systems you might use. Maybe it's a Google Sheet, or maybe it's one of the software systems we talked about. If you are paid more than $600 as a freelancer, you should get a 1099 at the end of the year, but you may or may not actually receive it. And that's okay. As long as you're keeping track of all of your income and expenses, you'll have the information you need to report accurately on your income tax return. And remember, even if you don't get that tax document, you are still required to report all income from whatever source is derived. This is a great question about estimated tax payments. In general, you're going to want to make estimated tax payments if you are going to owe $1,000 or more when you file your tax return at the end of the year. So let's take a look at two quick examples to see what that looks like. So for this example, we can see the person has income from their W-2 job of $35,000. Their W-2 job is withholding taxes on that amount for $2,420 during the year. From their freelance business, they'll have $10,000 of income and $8,000 of expenses, which is an extra $2,000 in net business income. The self-employment tax on that will be just over $300, and after we adjust for the standard deduction and half of that self-employment tax number, their taxable income is $11,084. That means their real total tax for the year is going to be $2,846. That's the sum of their federal income tax and also the self-employment tax. Now, $2,846 is a little bit more than what they withheld from their W-2 job. So they will end up owing $426 when they file their taxes for the year. In this next example, we'll see the same income from the W-2 job, but in this case, the individual is making considerably more from their freelance business. They're bringing in $25,000 and they have about $8,000 of expenses, so their net business income is $17,000. That ends up costing them $2,601 in self-employment taxes. Once we add their income to their W-2 job income for the year, their total income is $52,000, and after adjustments and that standard deduction, their taxable income is $36,849. When we run the numbers, their total tax for the year ends up being just over $6,800. That's the sum of their self-employment tax and that total taxable income amount. That is considerably more than what their employer is withholding from their W-2 job. So for this person, they're going to end up owing $4,383 when they file their tax return for the year. This is definitely a situation where this person would want to make estimated tax payments, since what they expect to owe at the end of the year is more than $1,000. If you need or want to make those estimated tax payments during the year, like the person in that second example would want to do, there are two ways of doing that. The first way is to ask your W-2 job to withhold a little bit extra from each paycheck. You can do this by adjusting your W-4 in step 4 and putting in an extra withholding amount. For this person, if they get paid twice a month for 24 pay periods during the year, they would want their employer to withhold about $180 extra from each paycheck. That would cover the additional taxes they think they're going to owe. If that isn't an option for you, the other option is to go directly to the IRS website. It's irs.gov/payment, and there you can make your own estimated tax payment throughout the year. So this is a great question, and the answer is probably. When it comes to subscriptions, as long as they are ordinary and necessary and effectively connected to your trade or business, they are generally deductible. Now, here's what you want to watch out for. If you're a filmmaker, it absolutely makes sense that you would have ordinary and necessary subscriptions to film-based services. We do want to make sure that there is a business purpose there and it's not simply aspirational. And realistically, if some of your use of those subscriptions is personal and not connected to your business, we'd want to separate out that personal use. This can be an estimate, of course, based on what you know about your business, but in general, subscriptions that are ordinary and necessary and effectively connected to your trade or business are deductible. So in general, if you donate work to a qualified nonprofit, that can be a tax deduction to you. However, you can only deduct the cost of the materials that went into the piece that you donated. You may not deduct the fair value. The cost would be the actual amount you paid for any of those direct things that went into the piece. And the fair value is what you would have sold it for, or maybe even what the nonprofit auctioned it off for. You can only deduct the cost of the work that you donated, not its fair value. And when it comes to services, your services are not deductible. So while it is wonderful that you might donate an educational workshop or other types of creative services, donating your time is not deductible. And when it comes to that cost, as you're calculating cost, your time does not factor into calculating that cost either. Why? Because donating services or donating your time is a wonderful thing to do, but it is not tax deductible to you. Now, this is a really interesting question because this came up in the context of donating your work. So what if you don't donate the work, but you put it on loan or lease it out to somebody? In that case, the work still belongs to you. It is still your asset. So in that case, if you have loaned it to a business to display for a period of time, you might have income, essentially rental income related to your work, but you wouldn't have any deductions for the work since it's still your asset. You might have shipping or you might have some installation costs that would be deductible, but the work itself still belongs to you. Now, in a different scenario, maybe you loan your work to a restaurant and they don't pay you. They simply say, you can show the work here, and then if it sells, you can collect the income. In that case, you wouldn't have any deductions either, since again, the work still belongs to you and you wouldn't have any rental income associated with that. In both cases, though, you'll want to make sure you have a contract with whoever is loaning your work or borrowing your work, and you want to make sure the work itself is protected in case something were to happen to it while it is on loan somewhere else. That's not really a tax answer, but it's a good thing to think about when you think about loaning your work to someone else. If you are purchasing tools or equipment to use in your business, in general, the tools and equipment are deductible, as long as they are ordinary and necessary and effectively connected to your trade or business. Those costs are deductible. So for tools to attend a residency or for a computer that you use primarily in your business, I feel pretty good about you deducting the full cost of those purchases in the year you make the purchase. Now, for something like a computer, you would probably only have that cost in 1 year. You'll probably continue using it for future years, and as long as it's still primarily used for your business, that's just fine. But what if you purchase something larger or more expensive? Maybe it's a kiln, or maybe it's a larger, more substantial asset. That's when we might think about something called depreciation. Depreciation means you spread the cost of the asset over time instead of deducting the entire asset in the first year. Essentially, what we're doing is we're recognizing that an asset will last longer than 1 year. And because of that, we kind of want to match the deduction with the use of that asset. That's what we're doing with depreciation. As we have the asset and then use it up over multiple years, we're essentially recognizing the cost of that asset over those multiple years. Now, this can get pretty complicated pretty quickly. But what's important to know is that most businesses choose a dollar threshold. And if you purchase equipment or assets below that dollar threshold, even if they will last more than 1 year, then you choose to expense those purchases in the year you purchase them. That means you recognize the full cost in the first year. If you purchase something above your dollar threshold, that's when you would elect to depreciate the asset over time. Now, this dollar threshold really does depend on your own business. If you are a very large business, you might choose a dollar threshold that is maybe $10,000 or $25,000. If you are a smaller business, you might choose a dollar threshold that's $1,000 or maybe $5,000. This is a good time to maybe consult with a tax pro to see what dollar threshold makes sense for you. But in general, once you choose the threshold, you would depreciate any purchases that are above that threshold and expense any purchases that are below that threshold. And just like the questioner asked, it is pretty common that you will have both types of purchases in a given year. So you can have both types of deductions on your Schedule C. So when it comes to tracking your inventory, you want to track your inventory at cost. That is what you paid for the inventory itself, or what you paid for the materials that went into the inventory. So let's say you're a musician and you're buying some t-shirts and hats and tote bags to sell as swag. You would track that inventory at the cost you paid to acquire those items. Not what you're going to sell them for, but the cost you paid to acquire those items. Or if you're a fine artist, you would track the cost of the piece based on what you paid for paints and gouache and canvas and anything else that went into the piece. The cost of the inventory does not include your time. And this probably feels familiar because these are the same rules that apply when we calculate the deduction you get for donating your work. What you are donating is the cost of the materials that you are donating as opposed to the fair value or the selling price. Why? What you're donating is what is in your inventory. So we track inventory at cost. There's a great way to calculate the cost of goods sold each year as part of your inventory on the back of Schedule C. The way the calculation works is it starts with the cost of your existing inventory at the beginning of the year. Then we add to that number any materials and supplies you purchased during the year. And we subtract whatever you have left at the end of the year. The result then becomes the cost of the items that you sold during the year. If you are an artist who tracks their inventory for their work or for related products you might sell, this calculation for cost of goods sold is a wonderful way to calculate that deduction each tax year. So even though this was a conversation about income tax, there were a lot of questions about sales tax. So let's take a minute to walk through some of these things. The first thing to do is to figure out if what you are selling is subject to sales tax in your tax home. That is the place where you live and do business. Sales tax rules vary substantially based on the state or territory, so you'll want to spend some time understanding if what you are selling is subject to sales tax in your tax home. In general, tangible personal property is subject to sales tax. However, different states define tangible personal property differently. Some states define it to include digital products, products delivered electronically, sometimes even music downloads. So if you live in a state where tangible personal property is defined to include those things and you sell those things, there's a good chance what you are selling will be subject to sales tax. There are also a handful of states that impose sales tax on services. So again, take the time to understand what is taxed for sales tax purposes in your own state, and then go from there. That's step one. If what you are selling is subject to sales tax, you generally have to get some sort of seller's permit or vendor's license or sales tax license. Different states call it different things, but this is basically permission from the state to collect sales tax when you sell things that are subject to sales tax in your state. Once you have that, you collect the sales tax and then you send it to the state. Most states have electronic portals where you upload your sales tax return and you upload whatever funds you have collected, sometimes monthly, sometimes quarterly, sometimes even annually, depending on the state. So that's for your tax home. If you are making sales to other states that are not your tax home, in general, you need to understand what the sales tax rules are in those other states. And that can get very complicated very quickly. The general rule that was upheld by the Supreme Court in a court case called Wayfair versus South Dakota is that if someone sells less than $100,000 of goods or has fewer than 200 transactions, they will not be subject to sales tax in a given state. But remember, that is just for states that are not your tax home. You may be subject to sales tax in your tax home, even if you have just one sale during the year. But if you are selling to other states, look to see if those states have established thresholds for sales tax. And most states have adopted $100,000 and 200 transactions as the thresholds when businesses become subject to sales tax. It is your responsibility to pay attention to your sales, especially if you start to nudge closer and closer toward that 200 transaction level. Start to pay attention to those levels and your sales and where they're going. And if you start to get close to those thresholds, go ahead and look up the sales tax rules in whatever states you are selling to make sure you're compliant in those states as well. So that wraps up all the extra questions that we didn't have time to get to live. Thank you so much for your participation, for your really wonderful questions, and for all the work you do in the world. Huge thanks as well to South Arts and all of their supporters for facilitating these wonderful annual tax conversations. Have a great one and happy tax season.